In today's class, we have a little bit of a hodgepodge of materials. We'll start off with a little discussion about security selection and trading. We'll get into hiring managers, so then we'll get into, if you're not going to do it yourself, you're going to hire someone else to do the investing for you. How do you find managers? What are those legal forms, whether it's the mutual fund or an exchange traded fund or a commingled account. Quick discussion on active versus passive investing. We talked a little bit about that early in the semester. This time I want to tie it to the efficient market hypothesis and just what are the theories behind that. A very quick discussion on shorting stocks and buying on margin. I know the week I'm doing this video, the whole GameStop shorting scandal and Reddit and all that was going on with that was just heavy in the news with Wall Street. Today, GameStop stock price is down quite a bit, but it's just been an incredible roller coaster. It'll be really interesting when you actually watch this class on March 1st, how all of that worked out. My guess is we'll probably have some resolution by March 1st, but we'll see. Maybe that'll be our discussion for that week of the class. We'll talk some on expenses with investing, which is a pretty huge issue that I don't think most retail investors realize. There's a lot more going on behind the scenes when it comes to expenses. And then we'll talk about measuring returns if we have time. We may not get that far. So let's talk about buying a security. You want to buy securities. You want to buy bonds. You want to buy stocks. Well, the SEC Act of 1933, coming out of the Great Depression, when the stock market crashed after the roaring 20s, the regulation came in and said, okay, for security selection, you're going to hire a broker, and then you're going to buy bonds and stocks from your broker. And the SEC Act is making sure that anytime anyone comes to the market to issue securities or borrow money, that they have a prospectus that gives you all the details about the company, that they're honest, that they fully disclose everything needed for you so you can make a good decision about how you're investing. The whole idea of a broker has radically changed over the years. We used to have these full service brokers that you could call and talk to, and they give you ideas about stocks, and then you do a trade, and that trade might cost you $50 to do a trade. Today, everything is online, and the trading is essentially free thanks to Robinhood, and then Schwab and other big brokerage firms have gone to the zero commission. Now, they still make money, and we'll talk about a little bit how they make money. They still make money from other things such as margin interest, but for the most part, commissions for trades have come down quite a bit. But we'll talk about the expenses of investing. So you hire a broker. I always have students asking me, Professor Sweet, can you give me a recommendation on a broker? And that's just, boy, that's not my area of expertise. When I was a portfolio manager, we had a trade desk that would do all of our trades. So I got spoiled, a little lazy. I would just walk out with a trade ticket, hand it to the trade desk, and they would execute the trade. The broker I use right now is Charles Schwab, and Schwab has been a really good broker. I really like what they do, but I know there's many others out there, Ameritrade, Robinhood. Some of y'all may use them. They were obviously heavily in the news, and maybe still at the time you're watching this video, heavily in the news related to the GameStop controversy. So the broker is going to trade through organized exchanges. Right now it's mainly electronic. When I do a trade online, I mean, it executes within a few seconds. It's really incredibly rapid. We have electronic custody. We don't have pieces of paper flying all over the country to show we have ownership. Everything's on our broker, online, and in electronic form. There are over-the-counter trades still today. This is mainly in corporate bonds and municipals. This is between two large buyers and sellers, very sophisticated. So over-the-counter, it just means that you're going directly. There's a broker that you call that is going to check their inventory, see what they have. They're probably sending you inventory, and you might be doing block trades in the millions of dollars at UTSA. They used to do them 50 million, 25 million, $50 million trades. And if you're a sophisticated investor, you have a security analyst that's there doing the analysis, coming back and making a recommendation. So that's where the big players are. Obviously, the controversy of the GameStop is, does Wall Street, the big hedge funds, these dark pools, these after-hour trading, is Wall Street taking advantage of the rest of us? And there's probably some of that going on, but it's also these huge over-the-counter markets also provide a lot of liquidity to markets that can be really, really important. When these markets shut down, like in 2008, when you get into a liquidity crisis, they can bring the rest of us down with them. So corporate bonds, municipal bonds, we talked about those earlier. They're much less liquid than stocks and treasuries and government agencies and mortgage-backed securities. So corporate bonds don't tend to trade. You don't just pick up the phone and do a corporate bond. If you do, you're probably losing 5 to 10% or more on the trade, especially when municipals. I actually have seen that, actual real life stories of small investors trying to buy municipal bonds and just losing 8 to 10% on the trade itself. Starting out way behind, they would have been better off using the mutual funds that we'll talk about next. So what kind of trades can you do? You can do a market order. A market order means you're going to buy at whatever the best price is. So you just say, hey, broker, I want to buy this stock. Get me the best, whatever the price is right now, you get me that price. I'll be happy. A limit order. This is when you want to buy a stock, but you don't like the price. Maybe it's trading for $100 and you want to buy it if it hits 97. So you'd put in an order, I want to buy 100 shares at 97, and your broker will wait and see if it hits 97 or lower, it will execute the trade. And let's say the stock closes today or yesterday it closed at 100, and today it opens up at 92. So people say, well, I put a limit order at 97, how will it be executed? Well, it'll be executed at 92. If your broker can get it at below 97, they will get it below 97. They're not going to get it, they're not going to pay exactly 97. Though you do have to be careful. I have seen sometimes where I wish I had not done a limit order, and I wish I just waited a little bit longer. But yeah, so your broker's going to get you the best price they can. But if you put a limit order at 97 and the stock drops from 100 to 92, you're going to be buying that stock at 92. So you better hope, if you notice the stock drop from 100 to 92 and now you're rethinking your idea, it's like, wow, I wanted it at 97, but now 92 looks rich. You'll need to go in and cancel that order so it doesn't get executed when the market opens. Same thing on the sell side. You want to sell a stock for 100 and it's right now trading for 97. And so you put in a limit order to sell it at 100. If that stock closes at 97, but the day it opens up at 106, your broker will sell it for 106. They're not going to force you to have to sell it below its market price. So your broker will give you the best deal that they can, but within the confines you give them. So if it's a limit order on the buy side, if they can get that limit order or cheaper, they'll do it. If it's a limit order on the sell side, if they can get that limit order or higher, they'll do it. A stop loss is kind of like a limit order, but it's one where, you know, you buy the stock today and then you say, you know what, I bought it at 670, but hey, if it falls to 640, I want you to sell it. Now, a stop loss, you might think, well, the most I can lose now is $30. I bought it for 670, I got a stop loss at 640. But you can lose more than that, because if the stock closes at 650 on one day and opens up at 200 the next, you got an issue. You better go in and look at that stop order and decide if you want it sold. So your broker will sell it once it falls below 640, and they're gonna sell it at whatever price they can get, even if it's well below 640. So there's a challenge there. I've never done a stop loss order, so I can't actually say exactly how they get executed if you had a discontinuous market where the stock actually were to open at 200. So I can't say for sure exactly what your broker would do, but I would make sure if you have a limit order or a stop loss order, you better know what they are. Keep track of them. How long is the order? Sometimes you can put an order that's good for the day, Sometimes you can do an order that's good till cancel. If it's good till cancel, then it depends on your broker. That might be 30 days or who knows what. I know people who do these orders and don't know they're out there. They forgot they did that order and it's still out there live for weeks. So make sure you keep track if you do these type of orders. If you're going to do your own selecting of securities, you're competing against MIT, Harvard, UTSA trained professionals that are out there. And we have several alums from UTSA that are doing some amazing portfolio management. And they're spending 40, 50 plus hours every week scrutinizing these securities in detail. You should talk to some of our UTSA alums, and it's just amazing the depth of the knowledge that they have in the securities that they trade. Far, far, far more knowledge, just a massive amount of extra knowledge than the typical investor has, and that's what you're competing against when you're going to buy these stocks individually. And so each analyst, they'll follow maybe 50 to 100 stocks at a time on the buy side. On the sell side, you might only have 8 to 10 stocks that you follow. You become a really deep expert, but you don't get to actually trade stocks. You're just giving people advice, giving them insight on the company. So you actually are barred from trading, so that you can't make some inside trades where you're trading ahead of your clients and trying to take advantage of them. So you're essentially blocked out of trading entirely. I remember I was on a vacation. We went to see the Olympics, and so when I showed up in Europe, it was with a friend of mine, and some other friends joined, people I had never met before. And there was one guy, he was a pilot for one of the airlines, and they all heard I was an investment person, a portfolio manager, and so suddenly they all wanted to talk to me. And it's amazing on the retail side how many great investors there are out there. At least everybody thinks they are. If you actually looked at what they were actually doing, you'd probably find out they're actually not that good. But his comment to me was, I got a great broker. He's really good. And I asked the question that I think ruined his entire vacation. But I asked him, well, how do you know he's any good? What's your benchmark to say that your broker is good? And he said, well, he calls me all the time with these ideas. And I said, well, that's great for him. Every time you do a trade, he makes money, so that's great for him. But how does he know? How do you know your broker is good for you? And he had no way of answering that, and most people can't answer that. I think that's why most people have gone to discount brokers where they just use a broker just to do a trade. But there was a time where your broker, is bringing you ideas, and you might trade on them or not. But how do you know they were good ideas? That your brokers, how do you know your broker is not just bringing you the hottest thing, GameStop, which is the stock that was been in the news along with AMC and some others because of all this short squeeze trading? How do you know he's not just bringing you something because it's in the news and he's just trying to get trades, generate income based off what's been hyped up recently? Is he really looking out for your best interest? And so if you did your broker's recommended trades, would you beat the stock market? Would you have a higher return than the S&P 500? Or would you beat your peers? Peers can be other investors in Lipper or Morningstar. How do you know your broker is doing a good job? And boy, I think, and he had no way of knowing that. He had no basis whatsoever of answering that question, which is true for most small investors. And so what most small investors do is they're going to hire someone else to do all this for them. They're going to hire a manager. We talked about that earlier when I gave you my 5 criteria, last class, 5 criteria for selecting a mutual fund, whether it's management fees or turnover, or how they handle gains and losses, or the turnover of the manager itself, or reversion to the mean, all those things we looked at. The fund management side is regulated by the Securities Act of 1940. So 7 years later after the first act. You should have studied these 2 acts. I remember studying them in detail. You should have some review of them and understanding them. Some of you will be working in industries that have to be licensed because of what's in these acts and other bills. So it's an important concept. So if you're going to hire a manager, how would you do it? So there's several ways to do it. We're going to talk about mutual funds, exchange traded funds, your 401k plan, commingled accounts, separate accounts. There's several different ways you can do this. But let's start with mutual funds. when I finished my career, when I retired from USAA, I was running their equity mutual funds and strategy mutual funds. I was portfolio manager on several of those funds. Not my favorite area. I'm not a huge fan of mutual funds. I use a few mutual funds today. I've been switching more and more to exchange traded funds. But mutual funds, what is a mutual fund? So an investment company, it creates a trust, and as their investors buy different shares of the mutual fund, that cash goes into this trust, and that trust then buys securities, and the trust hires someone to manage those securities. They can hire BlackRock, Vanguard, Fidelity, T. Rowe Price, you name it. There's so many firms out there, and we saw USA sold their business to Victory Capital. So when I worked for USA, I managed the equities of their mutual funds. However, the mutual fund board was a separate entity. And so the mutual fund board, they hired an investment manager, and they hired USAA to manage USA's mutual funds. Well, now USA's mutual funds have hired Victory Capital to manage those mutual funds. So USA has sold that business off. So it's an interesting company. You know, it's how does the mutual fund board of USAA fire USAA and hire another firm, or USA sold that out? I don't know exactly the legal structure USAA did to do that, but these are separate entities that hire BlackRock or Vanguard to manage the money for them. The mutual fund board for ours, the CEO of the USAA investment company was also the chairman of the mutual fund board. So USAA obviously had quite a bit of influence on that board. But the legal structure is important, and it's mainly protecting investors. The investors' money is in a separate account. This account is protected from creditors. So if BlackRock or Vanguard or Fidelity, if they go insolvent, your money as an investor is not going to be available to the creditors of these companies. You're in a separate trust. Your money is separated out. You can buy daily, but you buy daily on the net asset value at the end of the day. So the net asset value, they say they strike the NAV at the end of the day. The net asset value is the market value of the assets minus any liabilities that they have. I actually did this for just a few weeks. So the lady who did this at USAA for their variable products on the life insurance side, they had some mutual funds there. They had a strike every day. She went out on maternity leave and was asking for someone to handle her job while she was out, and so I volunteered. I always volunteer for stuff like that. Wow, it's a way to learn something new. And so every day I had to strike the NAV. I had to get the net assets of all the funds, get the net liabilities, subtract them out, divide it all out. So that the number of shares we had based on how many people bought shares and sold shares that day. And I would have to strike a price, and sometimes that price would go out 8, 9, 10 decimal places. I had to get it to balance out exactly. And so that's what firms do. They do it around 5 or 6 o'clock every night, and it needs to be correct. Every once in a while they will make a mistake, and when they make a mistake, it is a huge issue, because just think about it. Let's say you strike $19.32, and it was supposed to be $19.23. So you switch the 32 to 23, just a typo. And the next day, so people came in that day and they bought millions of dollars of that fund, and you put it in, and some people sold, some people bought, and the people that bought, you bought them in at 32 cents when you should have bought them in at 23, and the people that sold, you sold them out at 32 cents when you should have sold them out at 23 cents. And now the next day comes in, you note it, and now you notice there's an error, and yet you've done all these trades, people have done all this money, especially on the sell side. How in the world are you going to fix that? And that is a huge issue. And I remember once sitting at my desk, and they struck the NAV on one of my funds, and I looked at it and I thought, there is no way that number is right. So I called the accounting department. Fortunately, they had not gone home yet, and I told them there is some error in my fund calculation. They went back and they found the error. They had to stay there late, but they weren't cussing me or mad at me. They were actually quite happy, because if they had not caught it, if they had let that ride and had done the trades for the day, it would have caused a massive problem the next day. So I was careful to check my funds, at least to make sure they were in the ballpark. I didn't know exactly to the penny what the NAV should be, but I had a pretty good idea. So you can always get out at the end of the day, but you can only get out at the end of the day. You can't do intraday trades. So 4 o'clock Eastern time, 3 o'clock San Antonio time. So if you want to trade a mutual fund, you've got to get the trade in by 2:55 San Antonio time, and they'll execute it. And yeah, it's then, but you don't know what price you're actually going to get. They have to strike that NAV at the end of the day. The advantage of a mutual fund is small investors can get great diversification without having to invest a whole lot of money. So mutual funds do have minimums. Sometimes their minimums are $3,000, maybe $1,000. Usually if you set up an IRA or a Roth IRA, traditional IRA, where you're putting maybe $50 a month away and you're doing it electronically, sometimes mutual funds will go down as small as I've seen as $25 as the minimum, as long as you had it set up that it comes out of your account every month. So you can do smaller transactions, but usually there's a minimum of $1,000 or $3,000 that you have to invest. So it allows small investors to, you only have $1,000, you invest $1,000, and suddenly now you have 500 stocks that you're invested in. So your $1,000 is spread over 1,000 stocks because you're investing with a bunch of other small investors. And some of these mutual funds are huge, just hundreds of billions of dollars mutual funds, and it allows small investors to invest with well-trained portfolio managers. Now, commingled accounts and separate accounts, these are the same as mutual funds, but they don't have stock tickers like mutual funds do. You can't go out and trade them with your broker. These are really over-the-counter. They're intended for large investors who directly invest. So we did a lot of commingled accounts and separate accounts when I was at UTSA. Commingled accounts, you usually have to have about $50 million to be able to invest in them. Could be smaller, might be as small as $10 million, but it's several $1 million. Separate accounts almost always have to have at least $50 million to invest. I know there's one wealthy individual I worked with here in San Antonio. His net worth was, I don't know, $70 or so million. USAA actually set up a separate account for him and did it at a much smaller amount just because of his relationship with USA. But generally, a separate account is going to be much larger. The separate accounts I did were usually a few $100 million, just because what you're trying to do is you don't want to be in a mutual fund, because then if there's some kind of run on that mutual fund, all these small investors want their money out at the same time. It could actually harm you as an investor. So if you do a separate account or commingled account, you're in there with a bunch. Your separate account, you're all by yourself. It's just your money separately managed. So there's no one coming in and say, we want our money out. With a commingled account, it's you and a few other large investors, and there's rules that prevent one large investor pulling all their money out at one time and causing a fire sale. So commingled accounts are really for larger investors. Exchange traded funds, boy, these are interesting things. This is the big thing that's happened the last 10, 15, 20 years. They really are taking over volume from mutual funds. An exchange traded fund really is a mutual fund, but it's a mutual fund that trades like a stock on exchanges. They tend to be much more liquid, and you can trade them intraday. You can trade at 10 a.m., 11 a.m., noon, 1 o'clock, 2 o'clock. You can trade them just like any other stock. In this last bullet, I used to not believe this, but I do now. I can now see that you really can get better control over the timing of tax gains and losses. If exchange traded funds do a trade, just like mutual funds, if they do a trade and that causes a realized gain, they have to pass it on to their tax holders, their investors. I'm sorry, to their investors. But with exchange traded funds, and I can't remember the exact article I was reading that convinced me that, yeah, there is more control over those taxable gains and losses if you have an exchange traded fund than if you're in a mutual fund. So there is an advantage there. We'll look at a few of those here a little bit. And then the last area, which is really where probably most of you will be, and probably will be the biggest part of your investment portfolio the first 10, 20 years of your career, is a 401k plan or 403b plan if you're working for a not-for-profit. So essentially these are commingled accounts, and some of them are actual mutual funds that you get from your employer's retirement plan. Often the employer will match your contributions. At USAA, they match up to like 8% or something. So if you're not contributing, you're throwing away compensation from your employer, because if they match up to 8%, if you invest $1,000, they're throwing in an extra $1,000 in there, and so that's a huge advantage. They look a lot like mutual funds. They usually have end-of-day type of trading as well. So if you want to move and reallocate between different 401k plans, you can do that trade. You've got to do it before 3 o'clock San Antonio time, and they'll do the trade at the end of the day. So they trade very much like mutual funds. There's no intraday type of trading on these type of accounts. A lot of 401k plans now offer a Roth 401k plan option, so you should seriously look at that. I will warn you, the Roth IRA and Roth 401k, you're essentially trusting the government that they will never tax your Roth. Right now, that's what the tax rules say. Who knows 20, 30 years from now if the government can keep that promise, given how large deficits are. But right now, our Roth looks really good. You don't get tax benefits today, but whatever you invest, it's tax-free for the rest of your life, and that's a pretty huge advantage. One thing I would definitely warn you on with a 401k plan is a lot of employers are shifting to bundling. USAA has just recently done something which worries me, that they're going to switch to bundling. I fought bundling very, very, very hard when I was at USAA. Actually, twice I had to do that battle. There was one meeting I went to where the head of our human resources was really mad at me because I kept questioning, why do y'all want the bundle? And she got so mad at me, she said, I'm going to bring it to the committee and they're going to vote and we'll just shut Ron up. And so she brought it to committee. I went to that meeting ready to follow my sword. I was going to risk my entire career to fight that issue. She brought it up. Fortunately, the president of the investment company, who was going to be my boss in a couple of years, which I didn't know that, but fortunately, he spoke up and he said, why would we ever do that? He did not want to do bundling. And I sat back and so glad. The CEO of USAA at that time did not like bundling either. So I had some strong, powerful people on my side of the argument. So I probably could have won the argument, but it would have burnt some bridges if I had. So I was glad I didn't have to do anything. But it looks like they may be looking at this again. So what is bundling? Well, when a firm bundles, first of all, a firm, when they offer a 401k plan, they have a fiduciary responsibility, which means when they offer this plan, they can only make decisions about this plan that are in the best interests of the plan participants, the employees. They cannot make a decision about the plan that benefits the employer. With bundling, what the employer is saying is, we are going to offer our 401k plan to our employees, but instead of paying fees to the custodian, to the record keeper, what we want record keeper services for free, but we'll do business with a firm like Fidelity that has their own mutual funds and own 401k plans. We'll do business with them. We'll do business with them. Fidelity would do all the record keeping for free, and our employees, they get all these funds from Fidelity, so they're no worse off. And that's the argument, is we save $500,000 on record keeping just by picking this particular 401k plan provider. And our employees, they're okay because they're getting good mutual funds from this provider. And Fidelity's a big one in this business. Vanguard does this kind of stuff as well. The problem with that is when the employer saves $500,000, they save that by giving their employees a 401k plan that intentionally overcharges for their services to the employees. And so what usually happens is the employer saves $500,000 by passing on an additional $1 million in expenses to their employees. And that's important. We're going to talk about the expenses of investing. If you were paying 0.1% in management fees or 10 basis points in management fees, and then your firm bundles it and now you're paying 0.25%, you're paying 25 basis points, so you're paying an extra 0.15%. You are worse off. And that was my argument with USA is, why would you want to bundle this if you're trying to keep your fiduciary responsibility? And it got silly. At one point, they were going to offer the employees the exact same mutual fund that they had in their 401k plan, the exact same one, except for instead of getting it at 0.4%, they're going to get it at 0.7%. And I asked them, how in the world is that making the employee better off? They're getting the exact same product, but they're paying 0.3% more in expenses. And the argument they made, well, we're going to give them more choices, so that's just more choices. So more choices is it. But more choices, first of all, has never been a good idea for 401k plans, because employees get confused if they have 500 choices, and they tend to make really bad decisions. But giving them more choices but charging them a lot more money to get those choices doesn't make sense either. So large employers like USAA should not bundle. They should go out, find the best deal they can get from their employees, and the employer should pay for record keeping, and that should be it. Small employers have almost no choice but to bundle. They pretty much have to take whatever they can get because they're too small. But a big employer like USA that has billions of dollars in their 401k plan, they should be negotiating the best deal they can get from their employees, and they shouldn't pass on heavy fees to their employees. But we'll see. I'm not sure USA has done that. They may have just changed record keepers, and they're still paying the record keeper. They changed the Fidelity. Fidelity is a big bundling service provider, so it'd be interesting to see. I'll be able to tell if they did that, if they start offering them a lot of new options that have high expense Fidelity funds. Before we get into our next topic, which is active versus passive investing, I want to show you a particular portfolio. This is a portfolio I have for an entity I support, small entity. It only has $74,000 in its account, really small entity. And so if I want to do a trade, you just click on trade, and they give you all different kinds of trading that you can do. Trade stocks, they have bonds, they even have CDs. They have an all-in-one trade, which I use a lot because I do a lot of option trading, and it allows you to do a certain option types of trades. If you want to do a protected put or a covered call, we'll talk about those later. But we say trade stocks. You click on that, you can say, okay, I want to buy, let's say I want to buy Apple stock. So I put in Apple stock, and I want to buy, or I could sell. Buy means I want to buy it. Sell means I own Apple and I want to sell it. Sell short means I do not own Apple and I want to sell it. All right. So I want to buy. Quantity, let's say I want 100 shares. Order type. So I can do a market order. If I do a market order, that means just put the order in there, whatever price you can get, go for it. And there's a bid and an ask. The bid is what, if I were selling it, what I would probably get. The ask, if I'm buying, is what I get. You see that the ask is higher by 1 penny. The bid-ask spread is very, very narrow. But if I buy 100 shares, it's going to cost me an extra penny because I have to pay the ask price. So I could do the market order. I'll probably get something really close to 132.74. I could do a limit order. If I do a limit order, they're going to ask me what my limit is. So I might say, hey, I want to do a limit order of $125. And they say, well, that's going to cost you $12,500. I could do a stop order. If I do a stop order, it's going to say, let's do 125 again. A stop order, it's going to say, hey, we're going to buy it, but if it falls to this amount, we're going to sell. So market order is usually what I do, unless we'll talk about later a special kind of trade you can do. So if you do a limit order, that's when you have to give it good until cancel, immediate, or cancel, day only. You have your choice in there. So I'm not going to actually do this. I've hit review. It's going to show me what it's going to actually cost me. But that's how you would trade. So you would set up a brokerage account. You got to do all the paperwork. You might be able to do it online. Get it all set up. If you want to do special type of trades like shorting or options, you've got to do separate contracts for those kind of things. They have to make sure you're knowledgeable enough to do those type of transactions. So that's my account there. Let me talk about exchange traded funds. So the largest exchange traded funds are iShares and Spiders. iShares, there's Larry Fink. So iShares used to be owned by Barclays, but Barclays sold their iShares to BlackRock, and that's one reason BlackRock is the largest investment firm, portfolio management firm in the world. So there's good old Larry Fink right there. And if you look at what they have, you can see exactly our class there. They have stocks, they have bonds, they call it equities, but it's better to call it stocks. They have commodities, they have real estate. Now, by real estate, they probably mean real estate investment trust. They don't actually mean equity, true commercial real estate we're talking about. So they have the same we have, so stocks, bonds, and alternatives. They have regions, so we talked about that. North America, which is where U.S. Global, remember global includes everything. They have international, Europe, Asia, emerging, developed. So you have all these different categories, and so if we click on equities and go, they're going to show us equities. Well, guess what we'll see in equities? We're going to see exactly what we talked about in our class, which is large cap, small cap. So here's core S&P 500, IVV. I bought the IVV several times. Probably did billions of dollars in trades in that one. You come down here, they got the Russell 1000. The Russell 1000 is another large cap index. The Russell 2000 is a small cap. Here they even call it S&P 500 small cap. So you have the Russell small cap, the S&P small cap. You have mid cap. We talked about mid cap. EFA. EFA is developed markets. You have growth. Look at that, a growth fund. There's an emerging market fund. I don't know where it went. Emerging markets. Mid cap value. There's a value fund. They have some special type of funds. There's a Japan fund. So you can see, boy, on the equity side, everything we talked about in class. So remember bucks, beta, US versus US, capitalization, and style. That's all in here. On the US versus non-US, you have the US, you have global, which is everything. You have international. International includes developed, emerging. They probably have frontier markets in here. We'd have to look. There's frontier. They only have one on the frontier side. They do have one frontier. That'd be an interesting one to actually look at and get. So you can click on it. They have a fact sheet they can see, but that might give you more details. You can see how large it is. It's a pretty good sized fund, $430 million. They have 115 holdings. It'd be really interesting to see what those holdings are. You can look at the fees. It looks pretty expensive, but frontier markets are pretty expensive. So these are passively managed funds. They're not active, and 0.79%, 79 basis points is a pretty heavy fee for a passive fund. But frontier markets, they're just hard to invest in. You have to have special custodial arrangements. So then you look at what they have. You have Kuwait, Vietnam. So interesting, and so yeah. So there's everything we talked about in class. You're seeing exactly that. So then let's look at ETFs from State Street. State Street has the spiders. You may have seen their commercials where they actually have a spider lifting weights. So they have an ETF finder as well, and they're going to see the exact same thing again. You have it by asset class. So again, they have alternatives, which is commodities, infrastructure. I mentioned infrastructure in there. Public real estate, yeah, that's just REIT stocks. They have equity, core equity. They have kind of a frontier market, sectors and industries. I didn't talk about sectors and industries, but they do have sector funds now where if you want to just invest in tech stocks are semiconductor stocks. They have that. Market cap, exactly what we talked about. Large, mid, and small. We have style, growth, and value. On the fixed income side, they have high yield, inflation linked, investment grade. They have municipals. And then when you get into these, what you're going to see is you'll then see short term, long term, those type of things. They have smart beta now. That's something I recommended that you go out and do some research on. Very, very interesting. So there's all different types of ways that you can classify this, but very similar to what you did on exam 1. So you can see I wasn't showing you something radically out there in left field when what we did on exam 1. This is very conventional, very state-of-the-art. It's what everybody is doing. Vanguard also has some exchange-traded funds. They call them vipers. A viper is going to eat the spiders, so maybe that's why they did it, but vipers. And again, you're going to see the same type of thing. They've got government bonds long-term, just like we talked about, quality and duration. They have corporate bond funds, short-term, long-term, all that kind of stuff. And then they have stocks. They have large cap, mega cap. Wow, if you want really, really large companies like the Apples and the Facebooks of the world. And then growth funds, value funds. Russell 3000, which is large, mid, and small cap. Or the 500, which is large cap. Here they have mid cap, small cap. They have small cap growth, small cap value, one of my favorites, small cap value. And then you have the international. Remember, international? They have global, that includes the U.S., but when you see the word international, it excludes the U.S., but this is international on the bond side. Remember, these are going to be very sensitive to currencies. And then on the stock side, you have the entire world, a global fund that includes everything, including the U.S., international, emerging. I doubt they have a frontier market, but it's possible. And then they have some sector funds. A lot of people know. Jack Bogle, who started Vanguard, he was really upset about exchange-traded funds. He fought hard against them. He actually badmouthed his own firm, Vanguard, for offering them. He in his view, Vanguard offering these exchange-traded funds, they were just encouraging their retail investors to the day trade. And he thought Vanguard should be for the buy and hold long-term investors. So he did not like this. Vanguard did it just because this is where the world is going. They almost had no choice because everybody's moving in this direction. They would have lost a lot of business. They're still the second largest fund family out there, and they did it without having to acquire, like BlackRock did, acquiring all of Barclays ETFs. Vanguard has built everything themselves. It's a very, very impressive firm. And then you can really specialize. So ProShares, what they do is they have the traditional type of funds everybody else has, but they also have what they call these geared funds. So if you look at, they have levered and inverse. Levered means you can get, let's see if they put some, so Ultra S&P 500, it's a 2x fund, which means if the S&P 500 is up 10%, they should be up 20%. So last summer when the S&P fell 25% or more, that fund could have been down 50% at that time. But they also have geared funds that are inverse. So what's an inverse fund? Well, an inverse fund, and they have different levels of this. This is a one-time. What this means, if the S&P is up 10%, down 10%, this fund will be up 10%. If the S&P is up 10%, this fund will be down 10%. And I think they even have geared funds that are inverse and levered. We'd have to just look for those. Ultra short, Ultra Pro short, let's see. That's a 3x. It's a scary fund. So last summer when the S&P was selling off, the people with this fund would be really, really happy. It'd be interesting to actually look at this fund and see how it did last summer. We'd have to get its ticker. So that would be a pretty impressive fund to look at. You get a fact sheet that will tell you all about the fund, so you can do all type of analysis on their websites, obviously, because they're trying to get you to buy their fund. So this fund is the SPXU. So here is the SPXU, and you can see last summer when the S&P dropped, it was up a bunch. It went from 87 to 207. So yeah, when the S&P, wow, that's pretty impressive. It was up almost 200% when the S&P was down 30%. So this is a 3x fund. So if the S&P is down, I mean, it did exactly what it should. And then if you bought it here thinking, wow, the market's going to keep crashing, you would have lost a lot of money. So these are dangerous funds. So it was, boy, look at that. It was at $207 and now it's at $29. So very, very dangerous funds. But anyway, so ProShares, they have these type of funds. This is what we call a negative beta fund. This is a fund that would do really, really well if the market crashes, but it's a good size fund. Look at that, $629 million in this fund. It's a large fund. So year to date, it's down 70% when the S&P is up 18. Over the last 5 years, it's down 45 when the S&P is up 15. So yeah, long term, it looks terrible, but it's doing exactly what it promised to do. So if you're really worried about the market, this is the type of fund you could buy. If you think the market's going to really sell off, this is the type of fund you can buy. So there's ProShares. Interesting. There's a lot more these kind of unusual funds that they do. You can just see they have geared on, even on the fixed income side, they have levered and geared, even on the commodity side. So if you think oil prices have hit their low, you could do a levered fund on crude oil, and that fund, it's 2 times. So if oil prices come up 10%, you'll make 20%. And there's other firms like that. This one, Direxon, they have some interesting funds. They have levered and inverse. So you know, if you're trying to look out, if I were doing these type of funds, I would definitely look for the ones with the highest assets under management, although I'd watch the fees. These funds can charge high fees. The other thing that's extremely important is to do what we just did, is go back and actually look at the fund and make sure it did what it was expected. A good example are the VIX funds, the VIX funds, the Volatility Index Fund. Some of these firms have VIX funds where they're going to follow the VIX. The VIX is the volatility, implied volatility of the S&P 500. So when volatility rises, VIX rises. But boy, these funds, with the VIX rises from 20 to 80, you would think that your VIX ETF would rise from 20 to 80, but they don't. They weren't tracking well at all. I won't show you one of those funds because it's hard to actually find one that has the history we need to look back and see. But I've seen some of them where the VIX goes from 20 to 80 and the fund only goes from 20 to 30 or 40. It's really hard because you can't actually buy the VIX. You have to synthetically create it. So you're really relying on the mathematicians of these funds to create these specialized funds. So that brings us to active versus passive. So with active investing, you're picking stocks, you're picking managers that you think will beat the market. So there you look at the S&P 500 index. It is a U.S. large cap beta. You might have seen the word core, C-O-R-E, on some of those ETF pages. What core means is it's not value, it's not growth, it's right in the middle. So I should have brought that up when we were talking about value and growth. So you have value funds, you have growth funds, and you have core funds that balance the two. So if the S&P 500 stock index is up 4.2% and you want to beat the market, you've got to make 4.2% after fees. And if you do, let's say you make 4.5%, then 0.3% is your alpha, your return minus the market. So what you do is you try to find managers with good processes that have historically done a good job. But historical performance is extremely inconsistent, so it's really hard to distinguish between luck and skill in this market. Probably 80–90% of active managers have underperformed their benchmark, and it gets even worse than that. There was a great study, I think GMO did this study, but they looked at U.S. large cap managers and found that, well, there's some that beat the market, but they beat the market not by picking better large cap stocks. They beat the market by buying some small cap stocks. So essentially what they did is not alpha to beat the market. Instead, they did beta. So what they did is they cheated. They were a large cap manager who was buying small cap stocks. Over the long terms, small cap stocks tend to have higher returns than large cap stocks. So if a large cap manager buys small cap stocks over 5 or 10 years, they're most likely to beat the market. But they did it with more risk. They bought riskier small. And you, as a small investor, you could have done that. You could have put 90% of your money in large cap and 10% in small cap, and you would have gotten the exact same result as these large cap managers. And so there was a study that showed the bulk of the outperformance of large cap managers was not due to skill in picking large cap stocks. It was rather them putting 5 to 10% of their portfolio in small cap stocks and essentially cheating. I mean, you could think about it. You could hire a manager and say, wow, my manager's done great the last 10 years. And then you discover all your manager did was put 90% of your money in an S&P 500 index fund and 10% in a S&P 400 small or 600 small cap fund. All they did is buy 2 ETFs, and then they charge you, 0.5% to do that. And you think, wow, great job. They didn't do a great job. They just went out and bought beta in another market that tends to outperform large cap, and they counted it as skill. So it's a very shaky business, very shady business. I just know in the time I was in the business, watching what our competitors would do, they all advertise how many 5 and 4 star Morningstar funds they had. And they would say 50% of our funds are 5 and 4 star or 3, 4, and 5 star. Well, yeah, 50% are, because anytime they got a 1 or 2 star fund, they would shut it down. So obviously the majority of your funds were 4 and 5, 3, 4, and 5 stars. If you shut down all your 1 and 2 stars, then the majority of your funds should be 4 and 5 stars. We were tempted to do that at USA, especially you say, well, I don't want to shut down a fund because it's got $100 million in it. Well, the way these ratings work, whether it's Morningstar or Lipper, is you don't have to shut the fund down. All you have to do is, let's say you have a small cap fund that's really performed badly. It's ranked, it's got 2 stars, it's ranked really badly. Well, you just say, okay, well, it's not a small cap fund anymore. Now it's a small mid cap fund. So you change its perspective, you change its title. And once you do that, Morningstar and Lipper and all the people that grade you, they say, well, it's changed, so all that history goes away, and you essentially get to start over from fresh. So when a fund's family says, 50% of our funds are 4 and 5 stars, they're cheating, because all their bad funds, they didn't shut them down, they just slightly changed them, so they lost all that bad history in there. And I see some of those commercials, and knowing what these funds do, I just say, boy, it's so deceptive. So passive is when you just buy the market. You buy mutual funds or exchange traded funds that they're just going to go out and buy the market. Their fees will be very low. I've seen them as low as less than 1 basis point, so 0.0001 a year. I remember Barclays came and visited us once, and they were charging us 1 basis points. And I looked at these four people sitting across from me, thinking, you paid more in travel costs to get here than we pay you in a year. How are you making money on this fund? But they are visiting other clients, so all of their travel expenses weren't coming from us. But yeah, they charge us so precious little. And you're benefiting from markets being efficient, the efficient market hypothesis. And there's 2 ways you can talk about market efficiency. I don't really push it, market efficiency. I do recommend, there's a book by Dr. Andrew Lo, L-O, Andrew Lo, and it's called Adaptive Market Hypothesis. And in that book, he talks a lot about the efficient market hypothesis. You may have heard about the book Random Walk Down Wall Street. It's a famous book by Melchior, and that book makes the argument that markets are efficient, that it's a random walk. Andrew Lo, he challenges that and actually shows that there's things in that book that are not really true. So I actually recommend that you read Dr. Lo more than Random Walk Down Wall Street. But if markets are efficient, that trying to beat the market is a waste of time and money, because markets are just, You just can't do it. Markets are really efficient. How are they efficient? Well, they could be efficient with information. And that means anytime new information hits, new earnings, management reports some new product, that markets react instantaneously. So unless, and it's interesting, Wall Street, for the longest time, they've been trying to get closer and closer and closer to the exchanges so that their servers are 0.01 seconds faster than a server down the street, because they're 100 yards closer, so because of the speed of light, they're getting a fraction of a second faster. That's how efficient markets have gotten as far as it comes to trading. The second one is fundamental efficiency. And what that says is not only do markets react to new information, but they react correctly. All securities are correctly priced at all time. And if there are errors, the errors are uncorrelated. There are no market bubbles. So if a stock's mispriced, it's not because all investors are making the same mistake in the same direction. It's just, there's an error there because people interpreting the information. They're interpreting the information correctly, but new information is going to come out, and we're going to discover the market was had the wrong interpretation information. But that's fundamental efficiency. Most people believe in the first one and not the second one. But how do you test this? And Eugene Fama, famous gentleman in finance, still alive, still going, in fact is managing money at a fund right now based on his theories. We're not going to talk about the Fama French model. You might hear that in some of your other classes. But he has a model based on value growth and small and large cap, which is interesting. But he did a study back in the 70s, and he did 3 types of tests to see how efficient markets were. The first one he did was the weak form test, and there he was testing technical analysis. If the only information you have is historical prices, can you beat the market with that? And that's what we call chartist and technical analysis, moving averages. His answer was no. And I think one of the most interesting things he did is he went to chartist, he went to technical analysis, and he took them an actual chart that was created randomly by a computer, and then he gave them actual charts of actual stocks. And the technical analysts couldn't tell the difference between a chart was created randomly and an actual stock chart. So if they were seeing stuff, he was telling them, you're seeing stuff, but what you're seeing is really just random noise. However, since then, there's been a lot of analysis that says technical analysis does work, especially momentum. Momentum's the one thing that you can go out. If you want to read more on this, you can definitely read Fama. But I'd recommend you read Cliff Asness. His last name is Asness. He does some podcasts as well. You can go out to YouTube and listen to some of his. He talks a lot about this. He actually was a PhD candidate under Fama, and he wrote a paper on momentum. Fama doesn't say momentum doesn't exist, but he says that momentum is a reflection of risk and reward. You can explain it without markets being inefficient. He did a semi-strong test. Here he said, not only do we look at past prices, but we look at all publicly available information. His answer there was the markets are still efficient. You can't beat markets with that. If you take all publicly available information, markets are very, very good at taking information. There have been some studies that say that's not true. Your second paper in this class is on earnings releases. There's been studies that show earnings releases, markets don't immediately react to earnings releases. It actually takes several months. So, and there's hedge funds that have taken advantage of that. That might be gone now because hedge funds have found that and taken advantage of it. So they may have taken something that was inefficient in the market and made it more efficient. But this is related to the fundamental analysis. This is what I teach in my security analysis class. In fact, in that class, we do both technical and fundamental analysis. Fama says, no, you can't beat markets with this. Markets are just too fast, too good. The last thing was a strong form, and that says if you take all information, public and private information, you take all of that information and then you trade, can you beat markets? Well, obviously there he can't test that because if it's not public information, he can't get his hands on it. He tried testing it by looking at the trades of people who do have non-public information, like the CFOs of companies, and they have stock in their companies, and how did they trade knowing information. It's illegal to trade on material non-public information. You can go to jail. In fact, Martha Stewart went to jail not because of trading non-public information, but she was actually accused of that. She went to jail for something else, but related. But the question is it non-public information and is it material? It has to be both. So it is not illegal to trade on non-public information if it's immaterial. So if you're sitting on the plane and in front of you is the CFO of Valero, and you hear them saying, wow, when the market hears this, the stock price is going to move, and you hear that, you cannot go back and do a trade on Valero stock because of that non-public information. You might say, well, that's the CFO's fault, but they'll find you go out and you do a massive trade in Valero stock the next day, and then the day after that, Valero announces something that causes the stock to move a bunch. Yeah, the SEC is going to look and say, wow, Bob made this big trade on Tuesday, and on Wednesday they released this information. Oh, look, Bob was sitting behind the CFO of Valero on this plane the day before that. They're going to find you, or if your uncle make a trade, they're going to say, wow, this guy's nephew was on a plane behind the CFO of Valero. It is not illegal to use non-public. So if what they said was non-public, and it's not illegal to use immaterial non-public information. So if what they say is immaterial, that's okay. Now the question is it material or not material? And that's up for a judge to decide and a jury. The other thing is, let's say you have 1 million pieces of information. Each one of those pieces of information is immaterial, but combined it's material. That's still legal. You can do that. If you're out there and you're doing your own legwork, you're just out there getting every little scrap of information you can get. It's not public, but you put it all together, and together it tells you a story. You can trade on that. But again, it's going to be a judge and a jury that are going to decide whether or not you broke the law. So we'll stop there. We're almost done with this asset execution. So next class, we'll definitely get into measuring return and risk, which is an interesting topic and something really, really important because most retail investors don't do that well at all.